Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, March 25th, 2025. Hope you're having a fantastical day out there in the interwebs. It's a beautiful day here. I think the temperature might almost get up to 70. Well, maybe down in Denver, but it is nice outside. So I even have shorts on. So it is exciting. Me and my boy Jake are going to go play some ball time when we're all done with this exciting news broadcast. All right. Well, markets are mixed today as consumer confidence tumbled to a 4-year low, raising fresh concerns about the health of the U.S. economy. With the April 2nd tariff deadline looming, investors are on edge, oh no, over potential trade disruptions. Tesla saw a modest bounce despite a 47% collapse in EU registrations. Trump media popped a new crypto partnership, and KB Homes sank after weak earnings. Meanwhile, Moody's is sounding the alarm on America's deteriorating fiscal health. So before we break everything down, I need some help from you. If you can give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All right, let's get to the markets. Dow Jones was flat, up 0.01%, 4 points, closed at 42,587. S&P 500 up 0.16%, 9 points, closed at 5776. NASDAQ up 0.46%, 83 points, closed at 18,271. The VIX was down 1.95% today. It's at 1714. Canada up 0.14, Brazil up 0.57, and Mexico up 1% flat. In Europe, Germany was up 1.1%, the UK up 0.3%, France up 1.08%, the Netherlands up 0.58%, Spain up 1.21%, Italy up 1.06%, Switzerland up 0.24%, and Portugal up 0.86%. Russian exchanges read today, the MOEX down 0.45%, RTSI down 0.83%, and the overnight markets, the Nikkei in Japan was up 0.46%, Australia up 0.07, New Zealand up 0.53. In China, the Shanghai was flat at 0, Shenzhen Component down 0.43, China A50 down 0.07, DJ Shanghai down 0.11, Hang Seng down 2.35%, and the Taiwan weighted down 0.6. All right. I'm sorry, 0.46. I misspoke. All righty. Well, let's jump into the market recap. S&P 500 pairs some gains as investors weigh tech strength, weaker economic data. The markets started strong but lost some steam mid-session as investors juggled fresh worries about the consumer and the latest from Washington's tariff front. The S&P 500 inched up just 0.1%, and the Dow slipped a modest 17 points, and and the NASDAQ hung on to a gain in the tech stocks. But here's the big story. Consumer confidence took a hit. The Conference Board's index dropped to 92.9, its lowest since early 2021. That's got some economists waving red flags, with Jeffries warning the economy is, quote, cooling after nearly 2 years of red-hot consumer-driven growth. Well, when you pour a ton of money into the economy, it's really not shocking. This all sets the stage for a big economic data week. We've got February's core PCE inflation report, the Fed's favorite gauge, due Friday. A hotter than expected number could throw cold water on any rate cut hopes. But first, we'll get GDP revisions Thursday and housing data on Wednesday. Now let's talk tariffs. Markets were encouraged by reports that Trump's long-threatened Liberation Day tariffs on April 2nd may be narrower than feared. But don't relax too soon. He's still threatening new levies on autos, pharmaceuticals, and aluminum, with lumber and semiconductors next on deck. Meanwhile, EU officials are in Washington today trying to ease tensions, and peace talks on Ukraine are happening in Saudi Arabia after the U.S. and Russia met earlier this week. In the corporate world, Tesla eked out a gain despite a 40% drop in February sales in Europe. Blame tough competition and, well, Musk. And finally, CrowdStrike popped 3% after getting a fresh buy rating from BTIG. That's the latest from Wall Street, so there's probably going to be more drama later ahead. So very exciting. All right, let's get out of there. Let's get over to some data that came out today. February new home sales comes to us via First Trust and Mr. Bryce Gill. New home sales ticked higher in February, offering a modest recovery from January's weather and fire-related slowdown. Buyers purchased at a $676,000 annual rate, a number that's flat compared to 2019 and well below the pandemic highs. Despite the bump, sales still trail the pace seen in late 2024. The biggest hurdle, financing costs. Yes, mortgage rates have dipped slightly, now under 7%, but they remain elevated compared to where they were when the Federal Reserve began cutting rates last year. With the Fed now pausing those cuts amid persistent inflation, home buyers can't count on any relief anytime soon. One piece of good news: median home prices are down 1.5% year over year and nearly 10% below their peak from October of 22. Part of that drop is due to smaller homes entering the market. The median square footage for new builds fell 3.4% between Q3 of 22 and Q4 of 24. Inventory is also helping push prices lower. The number of completed single-family homes available has surged over 280% from its 2022 low. This is in sharp contrast to the existing home market, which still suffers from tight supply as homeowners hold on to ultra-low mortgage rates locked in during the pandemic. Looking ahead to 2020 to this year, the combination of lower priced homes and ample supply may drive a modest upward trend in sales, provided financing conditions do not worsen. Elsewhere in housing, the Case-Shiller index rose 0.6% in January, up 4.1% year over year, while the FHFA index climbed 0.2%, up 4.8%. On the manufacturing side, the Richmond Fed index fell to -4 in March, down from +6 in February, signaling a soft patch in factory activity across the Mid-Atlantic. All right, so it's kind of good news, bad news situation. New home sales are trucking along, but the existing home sales are kind of, well, I didn't lock it or do a new mortgage in after COVID, but I had a really good rate from 2017. So I looked at it, I ran the numbers. It just didn't make sense to pay all the closing costs and all that good stuff. So, all right, last up, got an article here from Zero Hedge. Commercial real estate delinquency rates increase in the fourth quarter. So, not good news there. Mortgage delinquency rates for U.S. commercial properties ticked higher in Q4 of last year, raising fresh concerns as nearly $1 trillion in commercial real estate loans are set to mature this year. According to data from the Mortgage Bankers Association, delinquencies rose across most major capital sources: banks, Fannie Mae, Freddie Mac, and especially commercial mortgage-backed securities, which saw the largest spike. While delinquencies are still historically low, MBA's chief economist Mike Frantantoni cautions that refinancing these mature loans could prove difficult amid elevated interest rates and challenging economic conditions. The concerned borrowers may struggle to roll over debt, triggering broader financial stress. The commercial real estate sector, a major pillar of financial stability, is grappling with rising vacancy rates, sluggish rent growth, and a slow recovery in office demand, particularly in large urban centers. The Financial Stability Oversight Council flagged CRE, or commercial real estate, as a high risk to the financial system, citing the remote work trend and oversupply in multifamily housing. Still, not all is doom and gloom. JP Morgan and Manulife Investment Management maintain a cautiously optimistic outlook for this year, noting resilience in industrial and retail sectors and even some stabilization in office space vacancies. In response to market shifts, many office buildings and underperforming hotels are being converted into residential units, capitalizing on ongoing housing shortages. And while risks remain, recent Federal Reserve stress tests suggest that major U.S. banks have sufficient capital buffers to withstand a potential commercial real estate downturn, even a severe recession scenario. Bottom line, the commercial real estate market isn't out of the woods yet, but adaptive strategies, resilient sectors, and a well-capitalized banking system may help cushion the impact of this year. Anyways. All right. Well, that is everything that I was going to cover for today. So if anyone needs anything from me, where can you go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. Give me a call. I'd be happy to help. All right. Well, hope everyone out there in interweb land has a good evening, and I'll talk to everyone again next time. Adios.